Good morning, everyone. It is Thursday, which means it's a special day. It's time for stocks to watch. Today, we're going to go and it's a blitz. We're going to go through stock tickers one by one and talk through what we like, where we see strength in the market, where we see weakness. Emphasis today on the weakness because, my goodness, it is going to be we're seeing some red coming up in the next few weeks, at least through July. But we're going to talk through it. First thing I want to bring up is something we've got in Foliko that rates the market. Now, for everyone that hasn't joined us before, Foliko is an AI-powered platform. We go out, we scan all the news so you don't have to. Look, if you were to read as many articles as Foliko reads every day, that would take you about 2.5 years every day. So instead of that, grab a cup of coffee and join us to review some of the data here. So here, what we have is our market outlook. Now, Tyler and I were taking a look at this data earlier this morning. Again, Foliko, we're producing 6 different indicators for every company on our coverage list. These 6 indicators, we call them health scores. And what they represent is how a company is performing relative to these specific indicators as represented in open source information. So we have ESG and systemic. I'm going to take them out for now. So now we have what we like to call our core 4. This core 4, they oftentimes in a company can act in tandem to show how well a company's internal mechanisms are working out to produce profitability, to showcase strength in management and reputation and brand. But we can aggregate all of these factors across our whole coverage list to make one central market index. And here's what we see. So coming out on the 10-week especially, this is going to be an interesting one. Right at the end of February, beginning March, the whole market was at a peaking state. And we've seen this just diving down since then for the past several months, getting further and further into weakness. Now, we do see on the 10-week a little bit of leveling off there. But one thing that I think is particularly interesting was that earnings power was really a holdout ahead of the other 3 for a long time. That earnings power indicator showing that companies were still showing some strength in their earnings, despite the fact that other indicators in the economy, inflation, consumer confidence, a lot of these other pieces were really hurting. And that's actually something we've been seeing reflected in real world data, that a lot of the earnings releases coming out over the past several months were a lot stronger than people thought due to a lot of strength, pent up strength in the consumer, strong savings accounts. Not really much weakness in debt or much risk of default. But as we see that earnings power indicator powered down more and more, that's leading me to believe that we're going to start seeing some real weakness in those earnings power or earnings releases coming up here soon on a systemic level. Now, a lot of people think that's bad, and that is bad, but that could point to the case being made that we could be reaching a market bottom here in the next few months. Tyler, what do you think of that as we're walking through the data here? Any thoughts, reactions to how I'm interpreting this?
Yeah, and like we were talking about this morning, we have, we're trying to make a pretty difficult call here insofar as, our data is, as I keep telling you, and I use this term, bearish as sin for the next 3 months, across, the growth and, the things that were held for the last 2 years. We think that's got a ways to go. I mean, every day I come on here and tell you how much, our data hates semis. It still hates semis. We'll pitch you some semi shorts later. But yes, I do think, we need some kind of capitulatory event. So if that's just a quarter of, absolutely jaw-droppingly bad earnings, that's something, that's a way we could get it there, right? If you, day after day of just washouts, that maybe you could get the capitulation that, everyone will tell you that we need to finally bottom that way through, earnings events or something like that. Maybe we'll see the capitulation happen a little bit differently this time, as opposed to just, a 3-day all out dump and the VIX goes up to 45, like, people have been traditionally used to.
Tyler, why is it every time we see anything green above 1% in the market, the next day every analyst on every talking show is saying, oh, this is probably the end of the bear market. This is probably the market bottom. Like, now's the time to get in, when really it's just a little bit of a relief so people can get out of positions, right? So do you know what we're going to be looking for to actually say, here's a bottom happening?
Yeah, I'd like to see the opposite of what we see now. When I go through my scans of, our FANG stocks, our semi stocks, our, again, our fallen bubble growth stocks, let's call them. When I go through there, they're uniformly bearish. When I go through, it's not like, 60-40 or 70-30. It's like 95-5, and I'm probably being generous. So I would like to see that start to change. I would like to see, all of a sudden we have some upside price forecasts on a couple of these. Doesn't have to be all of these, but that would be a nice change. Whereas, you look through a sector ETF, you look through Foliko's take on each component of the ETF, and it's bearish, and more bearish. So, that would have to stop. I'd have to see that change, before we started to get constructive. Again, some of the stuff we did in the FANG bottoming video, answer no, but we found, kind of looking for October context for a bottom. So, all of our timing lines up, quite well. So we could potentially actually see that bottom. But we do see significant weakness, before that happens.
Gotcha. All right. So let's start taking a look at some individual tickers. But first, real quick, Rush to Vish. Good morning, buddy. Thanks for joining us this morning. Look, we're here with you on all your questions on YouTube. That's how we're going to be able to get your questions. If you join our live stream on YouTube, we are live with LinkedIn, YouTube, Twitter, and Facebook. So come join us on any of those platforms. But if you want to dialogue, ask questions as we're going through specific tickers, if you have anything that's raising some doubts or thoughts in your mind, reach out to us, let us know, and we'll get those questions answered this morning. Again, Foliko is live today. So if you're seeing the data and you want to get some clarity in today's market conditions, join Foliko today. In the description below, you're going to see a link to www.cinerai.com, and that's where you're going to be able to get access to the beta today. So Tyler, let's jump right into it. What's showing some interest here today? So
here's my here's the hit list, for lack of a better term. So, I mean, I could have brought you a list of 100, 200, 300 stocks that we have, 20+% downside over the next 12 weeks on. I focused on these because I think these here. So we'll start with, when we did some analysis yesterday of the bad, CRM was the worst. So we have 23% downside on that in 12 weeks, which isn't, potentially as appealing as, some of these other downside targets. But I would say our conviction on this one is higher, that we will get a move. And I took the terminal break even just for the put side. This is not straddles. We're taking a directional view. So we're only taking one leg. So, we see an outsized move versus the market is basically, I'm just showing, how much of a bigger move we expect than the options market. Real quick, I want to talk to everyone about what we mean by levels of conviction here in Foliko. So in Foliko, you do get price predictions or price targets for a company over certain time horizons, everything from 1 day out to 12 weeks, right? However, there's a lot more to Foliko than that. You also get these health scores, and you can compare those health scores on a 1 day, 1 week, 10-week rolling basis, things like that. And this gives us a view of when all the alarm signals across all those different dimensions are blaring red, it's telling you something's going on here. CRM, yeah, that's a company. I personally, this is my personal view and opinion, I see a lot of bearish signals on that one particularly. I mean, what we were looking at it yesterday, the PE is what, 117? Some imaginary number, right? Yeah, I mean, there's plenty of room for downside here. Foliko thinks there's plenty of downside. Not that anyone tuned into this show for Tyler's technical analysis, but it's also, technically an interesting location to sell. So, I think there's a lot of potentially, interesting things to do on the downside in July with CRM. The next two I'll show you, I'll be brief because, I get on my soapbox on semis pretty much every day here, but Taiwan Semiconductors, ASML, we don't think the beating is done yet. Plus 20% downside on both. We've been short semis since June 2nd. I think our cover date on that is sometime in October, but we'll definitely do given all the bad things I've said about semis, when it's time to turn positive, we'll do maybe a full show on that.
So Tyler, you called the peak for semis at the beginning of this month, said that there's going to be a bleed out afterwards. Everyone was saying, no, there's all this pent up demand. It's going to be immortal forever, and it's just going to live on and be a happy story. Man, that has really come to pass, right? So what are you seeing for the actual bottom there? When is it going to be a good time, or should we just benchmark the market and wait for that?
I mean, I don't think people appreciate how far these moved over the last 2 years. So really what we're doing is in some of these names, I would argue, is not, unhealthy. Things just don't go in a straight line in the market generally, right? Like, we do, and those are great trades, but it ends at some point. There's no, aside from the Fed balance sheet, haha, Fed jokes, there's no chart that goes like this, right? Like, so, that's kind of how I think
you made fun of your own joke as you were making it. Like, you interrupted your joke to make fun of yourself.
That's a bad joke. I'm sorry, guys, but staring at the Fed balance sheet for the last 12 years will do things to you. So, I don't think that, that what we're doing is unhealthy. It's not like these companies are, their stocks are getting completely blown out because they're bad companies now. No, I as much as I, badmouth semis, they have a large part in a lot of things moving forward, in our day-to-day lives as, security and defense domestically and abroad, that whole interplay. So there's going to be a ton of upside when, things start to change. There's a bunch of future catalysts that could, bring them significantly higher, but we're not there yet. We think we need to let some more air out of the balloon first. I think when I wrote the article June 2nd, most of our data had a exhaustion date on I want to say October 11th, but we're not in the business of making calls 4 months out. So if we get next couple months and that date is it hasn't moved, we'll get back in front of you. We'll talk about what to buy. But until then, no thank you semis, no thank you software stocks. Another one like that. Paychecks.
Real quick, Tyler, while we're talking some tech here, we are getting a question here from Troyed. Are you guys going to discuss Tesla stocks today in today's stream? If not, at the end of the stream, can we discuss about it? So Tesla.
Yeah, sure. Okay. We'll do it live. So let's take a look. Interesting. So this is, oh boy.
I'm going to pull up Tesla here in Foliko.
Yeah. So I got a couple things I think people are going to like. So first of all, check out this price forecast. Just kind of sideways. Yeah. Interesting. I take notice of the shape of the projection line, and that's something you spoke about yesterday. So we don't see a lot of just, meh, for lack of a better term. We see up, upward, downward. We see, kind of squiggly, but we don't really see such a difference. It's pretty impressive actually, but go to the health factors and check out the earnings factor.
Now that's fascinating. Real quick, I want to point out for everyone new to Foliko and the view that you're going to get looking at an individual company, not only do we see these predictions and how the company is performing on these health factors, but I get an immediate view of some of the biggest tail end headwinds facing this company. Staff reduction, that's always an interesting thing, talking about why a company would be going through that cycle. But yeah, let's take a look at now the time horizon with these health factors playing out. Earnings power is positive right now, but look at that slope. That's not something you want to see. We find in health factors, again, for our education session, we're going to be doing it next Wednesday. We're going to be doing a 20-minute deep dive into what health factors are, where they come from, and how to use them properly. We look at them, or I look at them in 3 different dimensions. I look at the current raw score, I look at the 1-week slope, and I look at the 10-week slope. All 3 of those things come in to tell an interesting story, because if you just looked at the instant number today, you would see earnings power a little bit positive. But when you see a gentle downward slope, that's usually a pretty bad signal. When you see a steep slope like this, like I would call this right here a pretty steep slope downward on the earnings power, especially. And that looks like some bad news. What are you seeing there, Tyler?
Yeah, I mean, that's just gross. It's all rolling over and going negative at once. I don't, that's not a bullish characteristic in my experience, so while the price model has, Tesla going sideways, I don't see anything here that really excites me. And given our general market view, I think you can wait, and, Tesla should bottom with the market. If not maybe a little before because of the ARC component, but I won't get into that. But I think you can wait is basically what our data is telling you.
It's interesting that earnings power would be dipping in an era when everyone's trying to get a Tesla as, you're either getting a loan out to get a Tesla or to fill up your gas tank, either one. You might as well get a Tesla, right? And yet earnings power dipping down, that might call for a specific episode. I'd love to do autos. We should do an auto day, Tyler.
All right.
Ford with their F-150 Lightning having some troubles, and their whole success of the company hinges on the success of that truck. I wrote an article about it about a month and a half ago. So how that goes is going to really shape up. And then GM jumping in with both feet into the electric vehicle market. I think that'll be an interesting episode. We're going to do that probably the week of July 11th, I would say. Sounds right?
Good. Maybe the week after, but yeah, we're definitely, we're going to put it on the docket for this summer. We know Tesla is a high focus of a lot of people who are trading, so we'll make sure to pay some special attention there. Ford is interesting as well. So yes, we will definitely do a all-inclusive autos. Whatever it is they burn, we'll cover it. Whether it's Neo, GM, we'll do it all.
That staff reduction is hitting them. Companies with huge pent-up demand, and they could just be more profitable if they just hired more people and scaled up, don't go through staff reduction.
Right. And there's just a lot at play there. There's when time puts you on the cover, your stock's doomed, indicator. There's you have to sell all your Tesla shares to buy Twitter, and now you're stuck buying Twitter, fact. There's just a whole bunch of other things at play there. So big gap risk, big event risk, you're dealing with, the man, the myth, the legend, Elon. So, he's pretty much capable of anything.
Rush to Vish, health factors seem to even predict Tesla laying off 200 employees. That's an interesting thought. I had not thought about that before, that if you are working for one of these companies and you see your own earnings power health score dipping like that, is it time to start printing out resumes? That's pretty interesting. We've got a question from Cold Heart about AbbVie. I want to hit that question, but first I want to get back to your sheet, Tyler, and let's discuss the bottom half of your sheet. So Cold Heart, we'll hit your question here in just a minute.
Okay, so the other one we have nasty downside on, just real quick, is Under Armour. Mine, 40% in the next 12 weeks. That's a big call. I'm going to look at, potentially some puts on that, out of the money as a tail, just because, if that forecast realized, that's a view you'll get paid to take.
Did you see there was a recent branding poll just released where they were asking consumers to compare Nike, Under Armour, and Lululemon, what you think the most good-looking or popular brand for athleisure wear is, and Under Armour got 12% of the vote.
Yeah, and it's amazing because they were the first mover. They invented this whole space, right? So, to be the first mover and then completely blow it in such a fabulous fashion is I'm almost impressed.
Who can't make a t-shirt? You can get the same stuff on Amazon for extremely cheap. You're trading on full brand value there. And if your brand value isn't screaming good, that's trouble.
Yeah. So big downside ahead. So this is actually, I found this pretty interesting. So the other thing I started looking at yesterday when I, thinking about stocks to watch, I started looking through the regional bank ETF. And I found a couple shorts in there, and there were also a couple longs, so it's kind of a mixed bag in there. So I wasn't going to pitch the full ETF, to you guys as a short, but I saw some components in there, and I saw some larger bank components that we have. Basically, we're going to say the ECB is going to blow it, famously here. Look at these downside forecasts on DB and UBS. My God. Like I was saying to you yesterday, banks don't bleed like this unless, we're having a macro event. And with what's going on with the ECB, we could get that kind of scenario, right, where they just completely, the market sells the banks on rate hikes. That would not surprise me in the least. The euro's going lower as the ECB keeps convening, emergency meetings and swearing to God that they're going to hike to positive and all this stuff. So, the market's completely just, laughing at them. So, that's potentially an interesting short.
Now, Tyler, I did hear that a lot of these banks are trading at or below price to book.
Yeah.
How does a bank dive and hit further headwinds when they're trading below price to book? Like, doesn't that show some level of doubt that book's as valuable as they state? Doesn't that become more systemic?
Yes. It's completely a systemic trade because we can't get these targets. We can't get DB down 30% without some kind of macro shock. The one I'm proposing to you is, basically the ECB's failure to, do anything useful this summer, could push the bank significantly lower. It's also, book value. Book value is, sometimes up to interpretation. Where are you going to mark your stuff? If it's illiquid, who says it doesn't trade at par, even though I bought it at 60, so there's a whole lot of stuff there that I'm not accusing it, but I'm pointing out, like, it's not like 1 + 1 is 2. A mark is, you can look at 3 different services, pick the one you like the best, and that's actually a defensible mark. So, there's a lot more at play there. There is the markets and iBanking operations. If nobody can issue and all their clients are getting smoked, for example, that's not generally a good thing. So there are other line items that especially these two banks could blow it on. DB has been the sick man of Europe for quite some time. So there's no reason that in a macro shock we couldn't see that considerably lower. I will say, of this list, I think our favorite one in terms of conviction is HBAN, which is Huntington Bank. That one is a regional bank, and we see some pretty decent downside there. It's domestically based, so I think I would prefer to trade that one. Just especially given the model's view and my view of how badly the Fed's going to treat the market in the next 3 months. So that would be my favorite there. And as you can see, the market's not even pricing in anything close to that, right? Like,
Interesting. So now, Tyler, we are getting a question from AI-powered swing trader. If I'm not comfortable with options trades, how should I take action on these insights?
So that's interesting. That's something I talk to people about all the time. Being long is easy because it's a positive carry trade. You can just buy it and hold it. Obviously you have the mark to market and things like that, but it doesn't inherently cost money to be long. There's a borrow to be short. There's premium on puts. So if you need leverage in your account to short, so that is why I talk about it in terms of puts, because more people can trade options, which is kind of crazy, than can short shares. So the other way to do this would be to short shares. You can also find, I don't like these at all, the short ETFs. You're long an ETF with short exposure. I have a whole bunch of complaints about those, but if you can't short shares and you can't buy puts, and you can find a short ETF, usually a short sector ETF, like, I'll show you guys one, but to be very clear, I don't recommend trading this one. If you can short shares, short shares. If you can buy puts on the specific components, please buy puts on the specific components. There's a whole bunch of other things at play in these ETFs. So, there's leverage and the bleed, and it costs money to be in those ETFs. So you're paying a small fee to be in those. So there's just a whole bunch of slippage that maybe, you're not thinking about. So again, short shares, buy puts, but you can do something like
while you're pulling that up, did you hear the creator of the crypto ETF just created the first short crypto ETF?
Yep. So that's good for you crypto longs, because that's the kind of thing that helps us bottom. So what I was looking for on semis was SOXS. It's the bear 3 times levered. So that's the problem, right? Is you're effectively paying somebody else to buy the options for you, and then that ETF is going to decay if you don't get the move delivered. So there's a whole bunch of, it's a trading tool. Like that's not buy. Please do not buy and hold this. This is if you want to trade it for a week kind of thing, because you think we're going to get the move on a straight line. But please be careful with this. There is decay in these because you're paying somebody to buy options. You're also paying basically a management fee on the ETF. So be very careful with this. But that is if you are long only, that's a way to be short semis. Again, not my favorite way to be short semis, but it is a way that works.
Volume on this has just absolutely gone from 0 to pretty big over the past year.
Because there's a lot of people who potentially have the same problem that the gentleman who asked the question did. There's a lot of, if it's just your 401k you're managing, for example, you probably are just going to want to be short via longs, if that makes sense. So,
but again, to your point, Tyler, suppose you had incredible foresight to see all the market troubles and you wanted to take some bearish positions in semis like last October. You just saw the incredible valuations that, say, NVIDIA had or something like that. And so you went into this, you'd still be at a minus right now.
Yes.
Even though it's been incredibly bearish and rough for semis. So I agree. I mean, this seems like a dangerous thing. You have to not just have foresight, you have to have precision.
Timing. Yes, you have to. This is a timing device. So, we think our data allows us to do that. And that's why, we can say stuff like this. But yeah, if you just bought and hold this, you would have been impossibly right, but, you'd be down, which, there's no worse feeling in the world than being right and wrong at the same time. Because then you're just wrong. So that's door number 3, but I far and away, would prefer short shares, long puts spreads, anything like that, short calls. Like, there's a million different, there's not enough upside juice to be short call spreads, but the rest of those I think are pretty interesting. And would you mind running, so I just wanted to show you guys this. I think this is cool. The XLU over XLK.
Oh, yeah.
So this is, when you think about risk on, risk off, traditionally, obviously, some of these correlations have broken given the bond stock correlation has broken somewhat. But when I think about sector ETFs and just pure risk on versus risk off, my risk on, proxy is the XLK ETF, and my risk off is the XLU utilities ETF. So look what happens when, and I'm going to let Travis explain, exactly what he's doing, but it paints a very interesting picture.
So XLU, remember, this is p-values, and everyone new to p-values, we want to accept the alternative hypothesis at a certain level. So in other words, the way that you can interpret this, and I have switched the signs here. So for all you stats nerds out there, yes, these are switched. I'm actually labeling it with the alternative hypothesis. So if we're lower than 0.1, that is a good confidence to say that this is true. If we're lower than 0.5, that's strong confidence that this is true. And so we can say with some very strong confidence that XLU is at least equal to or greater than XLK. So statistically, our numbers are showing pretty good conviction that XLU is a better basket of companies than XLK. Does that fit, Tyler? Is that making sense how I'm describing it?
Yes, that's exactly right. Because yesterday when you were telling me tomorrow was stocks to watch, my stocks to watch were going to be utilities because we're bearish. So that would be one of those hidey holes, when risk is generally, selling off, you can potentially hide in utilities. But, that's no fun because the upside on that trade was very limited. So, we are giving you are ideas that have some more, downside here. But yes,
So-
I mean, that completely fits the narrative that, defensive stocks are going to outperform over the next month.
And so we have plotted expected returns for each of these baskets. Blue is the market. You can see our models are very bearish on the market going out 16 weeks, right? But we have green line here being utilities. And so utilities above the market at every level. Great. That's exciting, right? Until you look over and you see that, okay, above the market is at zero. If you're looking at that as your upside, instead of holding the risk, just hold the cash, right?
Right. Yes, and that's essentially what we're saying is you can either be short or try to figure out how to play for a stalemate this month, because we don't think it's going to be a good risk-taking backdrop at all.
Yep, absolutely. All right, Tyler, I got to go and trade some stocks. Last thoughts before we close out?
No, I mean, I hate being this bearish. It's pretty trying, honestly. Even though we've been right. To just go on and be like, yep, stuff in your portfolio is going down another third, maybe. But let's see. The data has been pretty impressive thus far. So, I have no reason to doubt it.
Cold heart, I'm sorry we did not get to your question today, AbbVie, but we would love to address that. We'll go deep on AbbVie another time. And join us again, 8:30 a.m. Foliko live every morning, Monday through Thursday. Friday, we're doing report cards. Our first report card, we're crafting it today. We need some more time to actually let our predictions ruminate a little bit because we produce the show on Thursdays, right? So if we're making predictions Thursday morning and then an hour later making a report card, there's not enough time for things to actually happen. So this week's report card is coming out next Friday. Don't miss it. See how right or wrong we are. Let's keep ourselves intellectually honest here. That's what we're trying to do. We are not a financial services company. Please, for any trades, consult a qualified financial services professional. We're just here giving some data and giving some opinions. Thank you, everyone, for joining. We will see you next week for our earnings roundup on Tuesday. Again, 4th of July, we're out. 5th of July, earnings roundup. Thanks all.